Good evening, everyone. You're all very welcome to this week's weekly webinar on our usual slot from Tuesday to tonight, Monday, the 8th of September. So as we look ahead to this week, there's a kind of a number of themes we'll be discussing tonight. In the backdrop of obviously the movements last week, NFP movements on Friday, which we'll be going through shortly, and of course previewing the major themes on data prints for the week ahead. So really, without further ado, the first place we're really going to start tonight is by recapping on last Friday's NFP print and really getting kind of some perspective on things. Now, obviously, as we looked to the markets last week, a truly abysmal number in the non-farm payrolls, as we saw the payrolls crash down. Now, obviously, there's going to be revisions every month in the labour market, but kind of going back to the narrative that we've been kind of looking at, the jobs market has become more pressurised, has become more strained over the last 6 months. We've kind of seen that in the JOLTS numbers. The JOLTS numbers dropping down from the high 9 to 10 million figure down into those mid sevens. Now we've seen a little bit of a robust kind of pullback in recent weeks in the JOLTS up to about 7.5, 7.6 million across the board. But when we look at the NFP numbers, when we look at systematically 2024, the traditional and kind of average prints we were seeing was anywhere from kind of 160 to 200,000 every month in 2024. Now we kind of knew that a lot of those numbers were probably artificially manufactured, because of the sense that a lot of the jobs we were seeing last year under the Biden administration was created through government contracts, government employment, and public sector rather than traditional retail sector. So we kind of got a bit of a false narrative. And of course, over the last 12 months, we have seen that kind of rotate back out as we've seen, obviously, Doge come through, the Trump administration, and kind of a more realistic expectation of where actual the job markets is. And of course, over the last few months, we've seen it go from kind of 100 to 120,000 down into the kind of 60s to 80s. And of course, on Friday, we saw that weak number at 22,000. Now, what that means on Friday, well, it's kind of reinforcing this idea of the Fed cutting in September. It's for me, it's an almost guarantee now at this point. I think if you were to look at Polymarket or any of these other sentiment indicators, you would say that we're probably somewhere between 85 and 97 or 98% likely to see a Fed cut in September. I think that's obviously what Powell has hinted at recently. My opinion, I think they're probably three months behind the curve. I think Fed interest rates probably should be 0.5% lower to 3/4, 0.75% lower, based on current data prints within the economy. And we know obviously that the Fed uses a lot of lagging indicators in their approach when it comes to evaluating inflation. I know a lot of other analysts in the industry, like Tom Lee, like Raoul Pal, and other key commentators have alluded to this as well. Now, I think obviously as we migrate last week, how did these numbers actually affect the markets last week? We actually saw quite a tale of two woes last week, because of course Tuesday we had that aggressive move lower in the markets, followed by that kind of robust recovery on Wednesday. We talked about that on Tuesday night, and we talked about into Wednesday, looking for that pullback up to really kind of where that initial sell-off occurred from on Monday, which was around that 6475, 6500 level on the S&Ps, but also incrementally around that 23,400 level, as we noted on the NASDAQ. And we kind of drew all this out last week, so it was a fairly clean play. From there, we kind of talked about, well, what was going to be the next move. And of course, on Thursday, Wednesday into Thursday, we saw that kind of robust recovery, but it wasn't without chop and volatility. As we move out of Wednesday evening into Thursday, we had market manipulators, we had volume, we had trickery in the markets last week. And Wednesday is the prime example of that, because of course, when you look at the fair volume prints and really where critical volume was traded at last week in the S&Ps and the NAS, we had, as I said, a tale of two woes last week as a whole, with that selling and aggressive recovery. But we also had it on Wednesday from a session to session basis, where we had almost within a 6-hour block, or within one US trading session, we had highs and lows simultaneously being liquidated above and below the value area, ultimately for markets to actually close flat. And it was really on Thursday when we saw markets into the latter end of the week. And of course we saw that aggressive move Thursday into the NFP print on Friday. This shockwave effect. I think there's two factors to consider here. One is that initial algo move. The weaker NFP print basically cemented the narrative that Feds were cutting rates, which of course we saw this spike. And then of course, as the market makers tend to come in, and as we tend to see on NFP, we had that massive correction and that massive dump off into Friday evening. And that's again what I mean in terms of being nimble, in terms of evaluating price action and understanding the fundamentals, but also being able to take advantage of that from a price action structure. So it's really then, of course, we saw that aggressive move. We kind of tailored off into the weekend, and then Monday on the open, we've actually seen markets again revisit those highs again. So there's a lot of volatility, a lot of chop. Tuesday, Wednesday, and of course on Friday. So last week, from a retail trading perspective, and even from a professional perspective, wasn't an easy week to trade when you evaluate price action on the day-to-day, but of course over the week. And of course, as I said, that really brings in that narrative now of, well, let's see what happens, because of course we've seen the NASDAQ very aggressive V-shaped bottom as we saw on Tuesday, but actually cement and test those highs structurally on the NASDAQ just below 23,900. But more prevalently, as we look at the S&Ps, this overarching viewpoint where we continually grind, continually create highs, continually create short-term dip opportunities has been very, very visible over the last few weeks. And this is, of course, if you actually kind of take a step back and actually look at the linear moves in these markets, every time there's been a sharp decline, and I mean what I mean by a sharp decline is where you're literally seeing straight line selling opportunities. The markets is creating these V-shaped bottoms. We had it in July, at the end of July, start of August. We also had it here again, 7th of August, sharp decline, V-shaped bottom, markets grind higher. And incrementally, we also had it at the beginning of September last week, sharp decline, V-shaped bottom, markets recovered. And incrementally, we saw it on Friday as well, sharp decline, fairly strong, prominent reaction from Thursday's value area, Wednesday, Thursday's value area around that 64.50, held firm despite that wick, and then of course edged back into that 6,500. So that is something that we have to be conscious of as you're trading kind of session to session, but as you look at the linear moves, and of course looking at some of the volatility over recent weeks, it has become a fairly centralized theme that a lot of these corrections, these pullbacks are seeing heavy buying almost immediately. And of course, for the one in the 22nd of August, from the Powell comments, we saw that grind lower, and then of course we saw that immediate bite back. So that really brings in the narrative of, well, what are we looking for over the next few weeks? Well, we've been kind of playing with the idea that these markets is seeing a systematic grind higher, adjacent to what we talked about in 2021 in previous Zooms over the last, or previous calls over the last few weeks. And we do expect this kind of idea to continue. Now, a lot of people are probably saying, well, is this kind of market over? Are we going to be starting to look for kind of more moderate corrections? Well, we've had ample opportunities really from June to see moderate corrections. And every time we've seen a moderate correction, we've seen the markets systematically jump to new all-time highs. And that has been none different than what we've seen. When you look at the 4-hour daily charts over the last few weeks, you've seen 1, 2, 3, and 4 new all-time highs over the last, five and a half weeks or so. So systematically, you would have to say that the trend narrative is still very much in play. But as I said, it's not without its corrections. It's not without its pullbacks. So if you're a short-term trader, you need to obviously be able to recognize this through the use of the likes of the VIX and the DXY. But also, if you're a longer-term player, you need to be able to understand that if you're buying monthly, let's say into a longer term investment, a pension, for example, or you're actually systematically looking to kind of DCA into these markets regularly, then these are the opportunities that you really want to be looking at. So when, as the old narrative says, when the market is fearful, that is really when you want to be taking the most advantage. Now, structurally speaking, when we start to look at targets for the rest of the year, I think we have to look at it on two fronts. I think, personally speaking, we've been an advocate of seeing 6,500 in the S&Ps. Even when markets was dying off in April, we were kind of looking for this recovery It was steadfast. It probably came a little bit more aggressive than we were expecting, because we kind of had year-end targets, personally speaking, and obviously within the company, 6,500s on the S&Ps. Those targets have pretty much been realized, but it's really now kind of going forward, what do we expect now? I think there's probably a little bit more left in the tank, particularly when you look at some of the key indicators within the US market outside of the NFPs. When you look at ISMs, when you look at forward-looking indicators like that, market conditions, you would expect the business cycle to really ramp up in Q4, and I think that will be an interesting narrative as we look out towards the ISMs, PMIs, and some of these other key indicators in terms of that. But also when you look at it from a technical factor, there's two kind of narratives we're looking at. One is obviously the 2021-2022 correction into this massive run-up that we saw in December, January, to this V-shaped bottom that we've seen that pretty much most institutions have missed. And if you listen to the likes of Tom Lee, he will allude to that as well. This is probably the one of the most hated rallies in these stock markets, because very little institutions have really been able to capitalize on these 20-25% pullbacks, but a lot of retailers actually were. Now, when you look at it, there's two assets that I would look at, which is giving me a 68, probably more aggressively a 6,900 to a 7,000 year-end target, if the business cycle continues to illustrate positive signs into Q4 with Fed cutting rates, and of course global M2 monetary supply ramping up. You're really looking at a potential target year-end into the, as I said, 68, 69s, but maybe even 7,000. Now, we've talked about it from a macro side of things, but when you obviously look at it from a systematic side of things, when we look at the price action structure, there's two kind of confluences that we're looking at it from that regard. One is when we evaluate the August lows, previous cycle correction bottoms, to the year beginning highs at what, 62, 6,300. We've seen an almost perfect 50% retrace on that basically aggressive market movement. Retest of those previous highs around that 48.50 handle, and that of course insinuates the 276 lateral extension movement into that 6,900 handle. Simultaneously, if you were to look at it from the other side and evaluate the short term, obviously grind higher beginning of the year, followed by correction, followed by this aggressive grind, and then kind of more recently, the last 3, 4, 5 weeks, this steady kind of short-term higher high, higher low perspective, you're obviously looking at that being a fairly strong possibility as well. Going from peak to trough, you're coming in roughly at around about 7,000. So this is where the idea of 68, 69, 7,000 certainly looks like a strong possibility if market conditions can continue to play out, if this global liquidity perspective continues to ramp up, like similarly what we saw in 2020, 2021. But of course, it'll, as I said at the beginning, it's not without its corrections. It's not without those 2, 3, 4% pullbacks like what we've seen in recent weeks. And I think when you look at the short-term perspective, it is obviously quite choppy, but we need to be able to look at beyond that, okay? And as I said, when you look at this correction here in August, this secondary correction at the end of August, and this third correction at the end of August, beginning of September, illustrates the nimbleness that as a day trader you have to be. You can have a longer term perspective, you can have a very, very clear structure in mind, but you also have to be contended with the fact that these markets are linear. They will move up, they will move down. There's a constant battle between buyers and sellers in the markets, and of course we have to be able to adapt to short-term narratives, short-term media events, geopolitical aspects. We also have to look at the volume, the ladders, and of course a lot of retail traders will look at fair value gaps, and then we'll look at all these different things, but essentially it's been able to ascertain the constant battle between the buyers and the sellers in the markets through the likes of the ladders, through the likes of the volume profiles, and of course you can use technical tools like, as I said, fair value gaps and smart money concepts, ICT, and whatever else on top of it, if it works for you. So I think it's important to put some perspective on things. I think this was probably the perfect way to start off tonight's call, because so much has happened in the last 3 or 4 trading days. It's important to be able to delve into a deeper level and really kind of evaluate the short-term movements, but also actually look at the broader cycle to be able to put perspective on things. So although we've created new higher highs, new all-time highs in the S&Ps on Friday, it's not without its volatility, it's not without its correctiveness, and the more probability is we could very easily see corrective movements again this week back down. But as I said, as a trader, It's the constant battle between buyers and sellers, and we need to be able to ascertain at any given time who are in control in these markets. Okay, and that for me is very, very important. Now, as I said, I'm still bullish medium to longer term. I think fundamentals are still going to drive these markets higher into year end, of which case then there will be a systematic rotation taking profits off the table. Longer term investments maybe moving back a little bit into cash, waiting for kind of moderate corrections like what we saw in April, 20%, and like what we saw in 2022 with 25% corrections. These are normal precedences in the market. And of course, particularly as we move into midterm elections year, which tends to be end of bullish cycle, start of correction cycle, like we saw in 2022. So these are relevant themes that we need to look at. So I think from this perspective, probably the best way to start off tonight's call by really kind of grinding in on the short-term price action, looking at the broader perspective to try and bring back a sense of kind of like calm and peace, and understand like that there is a lot of narratives on the shorter term, but obviously not to panic. And of course then, as we move through the economic calendar this week, off the back of those CPI or off the back of the NFP prints, it's going to be a fairly data heavy week this week. Of course, we have got on Wednesday, we have got PPI data with Chinese data. On Thursday, we've got ECB meeting, and again, it'll be interesting to see if there's any sort of cuts. ECB is already at its target in terms of interest rates at 2 to 2.15%. It'll really be interesting whether they start to obviously move below that into Q4. Now, given that ECB has been very bearish in its approach to these interest rates, and obviously cutting a lot more significantly and a lot more drastically than the US, obviously because of the state of the economy in Europe, there's probably going to be an element of holding, like what we're seeing in a lot of forecasters, and then obviously reevaluating as we move into October, November and December for more potential cuts. But I really would not be surprised if we were to see by year end ECB hovering at maybe 1.5%. And of course, when you look at both the deposit and of course the main refinancing operations, we knew that obviously the ECB had 4.25%. It was only a matter of time before it was going to start cutting. And of course, from the beginning of 2024, June of 2024, we've seen a fairly aggressive steepening in European central bank policy to bring those rates down, because of course we're seeing moderate inflation prints in Germany and a lot of these broader Eurozone members. So naturally, it doesn't really make much sense to have these interest rates at 4%. Probability is it'll go lower than 2%, because of course 2% is the longer run target. But if the economic conditions in Europe don't start to increase into Q4, we could very easily see a replication of what we saw in 2018, 2019, where we went from 3.5% all the way down into those ones, and maybe even potentially lower. And that would really be the interesting theme. You probably, as I said, we're going to get a hold this week would be the most likely outcome. And as I said, reevaluate as we move into October, November and December, because as I said, there's more capacity for the ECB to potentially run lower into year end. So keep an eye on that one. I think that's going to be an important print this week. But as I said, not expecting much in terms of movement. Now, of course, if we were to get a movement, it would be a surprise for the markets, which would probably actually help European equities, because of course ECB has been a little bit more on the dovish side. Other than that, of course, we have, as I said, PPI on Wednesday, looking for more directional bias, and of course we follow up with the CPI on Thursday as well. So Wednesday and Thursday, two very, very busy day for the markets from a central bank perspective, but also from an inflation perspective leading back into the US. Now we know inflation prints are coming down, and it's quite interesting that inflation prints in the US are at 2.7, 2.9%, headline figures and core at 3.1, but yet the US interest rates are still far too high. And of course that brings back to the comments that we said earlier on about the US interest rates at this moment in time relative to where a lot of these economic data prints are probably about 0.75% higher than really where they should be. And that is reinforced in a lot of these other sectoral data prints within the US economy in the broader end. So Wednesday and Thursday, very, very interesting. And of course, when we look at inflation data, like with PCEs, anything that's higher than expected is generally weaker for the stock market, but anything lower than expected brings in, again, a little bit more of an easing perspective and is generally good for risk orientated assets. So that includes the likes of the crypto side in the alternative investment asset class space, but also in terms of your traditional ETFs, your stock markets, your equities in the broader space as well. So Wednesday and Thursday, very, very busy day. Even today, for example, we've had a fairly successive move higher, followed by corrections in Europe, and of course we've seen some German data prints. So German data prints will continue to be important as we move into October and November, December. We've had some weaker prints at the middle and beginning of the summer. Some of the German data prints over the last month or so have been a little bit more resilient, so that'll be an interesting element to see whether those data prints in Germany actually hold up as we move into Christmas at the end of Q4, or we actually see European data struggle again. And if they start to struggle again, that's going to bring in this narrative of QE, increasing global monetary supply, both within Europe obviously, but also globally, and of course bringing in that narrative for the ECB to bring in bond buying initiatives like what we saw in 2019, in 2008, 2009, but more visualized over the last 10 years in terms of broader economic policy as well. All right, so a lot to digest this week, and of course that doesn't even include Friday, which of course has UK data prints. GDP month on month is out. It's expected to be 0.1% as opposed to the previous 0.4%. Again, your UK data has really, I'm not going to say flatlined, but it has really struggled over recent weeks and months. Again, this whole government in the UK, not to sound too critical of it, but they have handled it very, very poorly in terms of a lot of pre-election promises, what they're delivering against even the sectoral, as I said, data prints within the economy are pretty much all underperforming in the broader sense. And even when you look at manufacturing production and industrial production, also proving that point as well. So from a UK economy perspective, it's really in a, shall we say, not a dire situation, but a very unappealing as we look at it in the broader end. And of course on Friday, as we round out the week, we do of course look at Michigan consumer sentiment expectations indexes, both of which we are seeing holding up into those mid-high 50s. And of course when we talked about PMIs and ISMs and a lot of these kind of indexes, we obviously want to see them above 50, because 50 is where you're going to get that kind of way off between growth and recession. But also as we move into, as I said, Q4, you want to be looking at these indexes moving into those high 50s and into those 60 prints. And for lack of a better word, we are seeing them move higher. If you were to look at a lot of these indexes 6 to 9 months ago, a lot of them were in the low 50s. They are starting to creep up into the 50s, 3s, 55s, and systematically trying to move higher. So again, that will be a theme that we'll continue to monitor as we move into October, November and December in the back end. All right, so as I said, quite a busy few days ahead. Tomorrow we're not expecting too much. There is of course the NFP non-farm revisions, and that'll be something we'll obviously track tomorrow afternoon. But as I said, Wednesday the PPI print, Thursday ECB and CPI data prints, and of course Friday to round out the week we've got German data, UK data, and of course US data as well. So we have 2 to 3 fairly busy days coming up as we move from Wednesday, Thursday and Friday. Now I won't be around on Wednesday and Thursday, but I will be around on Friday, and we will be doing a weekly catch up this week in the face of the PPI print on Wednesday, in the face of the CPI print on Thursday, of course the ECB meeting, and as we move into the end of the trading week. So Wednesday and Thursday will be very interesting, will be worth paying attention to the data prints, and again reinforcing that to where these markets currently are at. All right, now as I said, we've kind of looked at the S&Ps, we've talked about the S&Ps in fairly great detail. Almost a similar type of narrative forms with the NASDAQ, because of course the NASDAQ, aggressive V-shaped bottom into a aggressive recovery. Now as I said last week, very, very bearish on Tuesday. We had actually, if we were to look at the NASDAQ last week and really hone in, we actually had made a new short-term lower low, because by virtue of the fact that we closed, but we hadn't really wicked below it. So that was always the risk that 23,000 could become a benchmark low. And that's exactly what we saw, because of course we had that V-shaped bottom, we held 23, we got back up into that value area where we initially sold off from Monday night into Tuesday, which is around that 23.4, 23.450 handle. And then of course, like with the S&Ps, we saw that aggressive volatility taking highs, taking of lows, really strong volatility, edging higher, aggressive wick on Thursday following the US Open, but holding the prior day value area. So you can even see that for yourselves. Wednesday's value area holding as Thursday's structural lows, refusing to break underneath. And then from, of course, we just had that aggressive grind into the close, followed by a lot of short-term bullishness in the backdrop of NFP, followed by market correction. Again, held Thursday's value area, and then from there we get that V-shaped bottom, dead cat bounce recovery, and almost immediate grind into Monday, beginning of Tuesday, where we retest those structural highs. So for me, we're going to get a lot of volatility short term. I think the next week or two, I think is going to be very interesting for the data prints. When you look at the NASDAQ on the weekly structure, it's not without its pullbacks, it's not without its corrections, but it is retesting those highs. So this week is going to be very interesting. As we move into Friday, a lot of data prints, a lot of narratives to go through. But it will be very interesting if we were to see the NASDAQ on Friday afternoon at this 24 handle and trying to push higher, because that again feeds back into that narrative we were talking about with the S&Ps in terms of this kind of grind higher over the next kind of 60 to 90 days. So really interesting to look out for as we move into Friday. And of course, a lot of short-term fundamentals. So of course, there is obviously still the potential for another move lower back into that 23 handle. And again, structurally speaking, if you look at the S&Ps and the weekly structure, you would say very, very aggressive move, just kind of isolating it. But again, not too surprising that we see end of August, beginning of September proving to be incredibly volatile. Now you're looking at price structure, you're seeing aggressive volatile moves up and down on a session to session, day to day, and even on the weekly structure. You only have to look at the last three closing candles, but also price structural movements on the S&Ps reinforces the volatility that we're seeing. So it'll be interesting to see if there was a correction in September. You got to be looking at kind of 63.50 short term, 6,200 for any sort of immediate correction, and then you're looking for that phasing out. We know August, September, end of August, beginning of September is a fairly volatile month. We know on record, if you were to look at the last 100 years of stock market performance, September is the worst performing month of the year. So we're not really surprised to see volatility as we move into September. It's just a case of evaluating to see if there is any short-term dips or pullbacks, trying to find those value plays to really catch the next move higher as we look into obviously the higher time frame perspective. All right, so S&Ps and NAS is a fairly interesting narrative to look out for. Again, a lot of volatility this week with news in the back end. If you were to structurally look at the Dow as well, kind of a very interesting narrative. We talked about this aggressive breakout last week of the 45 handle. That for me was very, very interesting. But again, when you look at the last 3 weeks, aggressive breakout, we have that retest last week into that breakout zone. And that's really where this breakout zone occurred from. When you looked at that 22nd of August move on the back of the Fed Chair Powell comments, you can see very, very clearly that those markets had almost completely unwound. Aggressive movement, has a state of holding and consolidation, gets the corrective move back down to the prior breakout area, which was this yellow area around that 44.8 to 45,000. We had multiple movements last Tuesday. We had it again last Wednesday. And then, of course, Thursday into Friday, we have retest of highs followed by correctional movement back down to last Thursday's value area, which is 45,200. So basically, in a nutshell, this 45.2 is your floor for any sort of downside pullbacks. But also when you look at price structure over the last 2 to 3 weeks, we are now in a contagion move whereby 45.8s is your short-term tops, your 45.2s are your benchmark lows, and anything structurally below that is your breaker bounce. So naturally, if we were to break through that value area, you're really looking for a deeper move to see, right, a closure below 45s instantaneously brings in the idea of this the 21st to the 22nd lows at around 44.7, with the possibility of a further extension if there was a broader narrative, if there was a broader weakening in these markets short term. As we know, systematically September's weaker. That is the type of move you'd be looking for. But of course, at this moment in time, with the breakout that we saw in August, with the subsequent retest that we've seen in the first week and a half of September, this US stock market, with all the narratives, with all the prior moves that we tend to see in September's gone by, you have to actually say that these markets are actually holding up residually fairly well. So let's see what happens over the next few days. A bad PPI or a CPI print, of course, would be a negative for these assets, and of course that is something that we do have to factor into consideration from a short-term perspective. But it's not just about the news, it's all about looking at price structure, it's all about looking at the narratives, it's all about looking at the cycle analysis. I've been able to coordinate a structured strategy that allows you to look at all of these different moving parts, collate it and collect it into one concise, easily digestible and understandable piece, and been able to look at all of these different elements while simultaneously developing, as we say, an edge in the market. So for me, really looking at these areas down here, your midpoint, when you look at the Dow Jones structurally over the last 3 or 4 weeks, effectively we're midpoint, right? So when you look at the anytime over the last 3 or 4 weeks, this 45.2, we have it here highlighted at the end of August, becomes a fairly 45.4 into 45.5 becomes a fairly important threshold, as that is essentially the midpoint between your lows and your anchored highs over the last 3 weeks of price structure. Okay, and as I said, the weekly time frame, if you were to remove all of these indicators just for a second and use a complete blank chart, putting some perspective on things, you've got your breakout, you've got your pullback, and as I said, these markets residually are holding up. So if there's any sort of correction, this is where you want to be trying to find value in terms of the next meaningful long position. It can be very difficult when you have ranges and when you have consolidation like what we've seen over the last 2 or 3 weeks. You will get chopped about quite a lot on the lower time frames because markets is navigating and is accumulating more volume within the price structure of the range that's been identified. And as I said, that is structurally between the 45.2 lows, and really where a market has proven to be very thin or quite thin up around that 45.8. And as you can see, 1, 2 and 3 successive highs and subsequent bounces back off it over the last 2 to 3 weeks or so. All right, so structurally speaking, important to be able to understand there's a lot of moving parts this week. We have to be able to caution on the risk because, of course, any sort of negative prints means corrections, means dips, means moves back to prior value areas, like as I said, down here or structurally down here. And again, on the NASDAQ, you're applying the exact sort of same logic. You've got aggressive break higher, you've got structural move here around 23.4s, you've also got benchmark lows in those low 23,000. So those become interesting narratives if these markets were to tilt. And again, simultaneously in the S&Ps, if we were to see that again, 6,500. Now, we have temporarily gone above 6,500, but if that was to prove to be a short-term top for September into a little bit more bearishness towards the back end or middle of this month, then you're again flowing back into that 64.50 and probably into those lower bounds, 63.50s, 400 benchmark lows, which you saw at the beginning of the month. And that becomes, as I said, very, very interesting because, of course, this was the previous high just above the all-time highs at around 64.8, 64.90. New all-time high. Markets again is back sitting on it. So that original high that was created in August, which was the first of the last 3 highs, markets is sitting on that price structure. So interesting narrative to look out for over the next coming days. Now, as we look at Europe, we've talked about the cyclical rotation in the likes of the DAX, in the likes of the FTSE, back into the US markets. We had the idea that probability is from H2, Q3, Q4, the US markets would outperform Europe. That was a strong conviction play we had, given, of course, how aggressive European equity markets were through the first 3 months of the year. Now, we talked about this aggressive move at the beginning of August. We've also talked about the subsequent move last week for price structure to come back down into that 23,500 handle on the DAX. And that remains really the benchmark lows as we move into September. We saw that aggressive V-shaped move last Tuesday. And of course, into those bottoms on Wednesday, we've seen a little bit of a rotation play. Short-term high into NFP, followed by short-term correction back down into the value area, which was formed last Wednesday. Now, from there, that has become the structural low, right? You can even see it yourself. Consolidation, aggressive breakout, falters through Thursday's value area on Friday, straight selling back to here. So it's no surprise that once we've taken out Thursday's value area, which is around about the 23,750, 780 handle, we were going to go straight back down at those 23.5s, and that's exactly what's happened. From there, like with the US assets, we've seen a more moderate recovery into the beginning of this week, But of course, we have already filled the gap. So there was obviously gaps on Sunday night into Monday's market open. They've been pretty much cleared on the DAX, but of course we're looking to see if there is any sort of negative headwinds, like for example CPI, PPI, ECB on Thursday. There is the potential for these European assets to potentially falter again. And as I said, 23.4, 23.5 is really your benchmark low. Anything sub that, you're really then looking at price structure rotation. Very, very strong H1. H2, probably not the case. And that really then brings in the idea of getting into those 23s, 22s, and of course we've talked about that in recent weeks. But for this moment in time, European equities, albeit they've been on the down foot for the last probably 6 weeks or so, 4 or 5 weeks in particular, from that 24.5 handle, the 23, 4, 23.5 are still holding as benchmark lows. And until we see more negativity coming through, we just have to be careful of the fact that we are in higher high, higher low, higher high, higher low. Is this the sign of a lower high? And if that is the sign of a lower high, then it's interesting to see, do we actually break through structure, or does this move into a more lateral type of structure, which we had here, and expands to cover this area here? And that really becomes the interesting narrative to focus on, as I said, as we move into Q4. So that becomes the narrative. If we were to see more accommodative moves this week, then you're really looking at a third drive in the DAX above 23.9s, and really moving back into that 24.2, 24.3, 24.4 handle, where we spent so much time in July, and of course where we had that V-shaped move down and back up in the middle of August before we had that subsequent drop off. So you just have to be careful of that. And again, the data prints, the volume, the ladders will help guide you into that to be able to ascertain sentiment on these assets. Now again, FTSE, very, very similar play. It was more aggressive and has outperformed the DAX. Again, aggressive breakout into the better half of August, followed by that apex or kind of corrective move back down right into these levels. Now, interestingly, last Tuesday and last Wednesday, structurally, we did take out those midpoint lows from the middle of August, which was around that 91 handle. We went straight through it, down into those low 9100s through 91.25, and that is of course where we found our bottom. And we talked about last week how that 91 level was going to be structurally important. That has proved to be the bottom of this initial corrective movement a week on. Now from there, we formulated bottoms. There was actually multiple tests, consolidation, a lot of volume up here, as I said, under that 9200 level, around about 9150, with corrective movements and bounces off of 91. So that was effectively the consolidation into last Tuesday, last Wednesday. Of course, on Thursday, with equity markets rising, we had that ascension followed by corrective move on Friday, and since then the FTSE has remained pretty, I would say, flat, albeit slightly higher this morning. We have created new lows structurally around lunchtime into the European close at 4:30, but benchmark lows effectively returned back to the value area, which was above 92 at around 92.25. Now again, structurally from there, this 91.75, 9200 level becomes short-term benchmark lows. Effectively, if you break through that, you're looking at more negativity and retest revision of 91s, with the potential for it to potentially break down. Okay, so other than that, let's wait and see. But given the markets has been quite steady over the last 4 or 5 trading days, again, not without its corrections, like for example on Friday, but overall holding up fairly well for the seasonality factor, the time of the year, and of course some of these data prints that's been presented as well. Now, what's helping or what's triggering a lot of these back and forths, these aggressive moves? Well, of course, it's been the VIX. Now, you look at the VIX, the volatility curve into month end, we saw the VIX pick up. We saw that aggressive movement on Monday and Tuesday of last week. But as the VIX tailored off, last Tuesday, we talked about how that VIX move was most likely going to come back down here to this 17 print, with the idea of don't be even surprised if it goes lower. We talked about this gap print from last Monday and last Tuesday being the probability of it closing was actually quite high. And in fact, a week on, you can see how this market has closed that gap and has actually found new benchmark lows at the 15 print. Now, Since then, Friday, obviously peak volatility, that aggressive sell-off that we saw on Friday in US assets has enabled that short-term spike into 16.5. But of course, the retest of the highs in the stock market has meant that the volatility index has retested those lows at 15. So that really becomes a case of any sort of trigger point or volatility increase off of this 15-16 handle formulates corrective movements in these markets. Even though the markets are creating all-time highs in the likes of the S&Ps, a little less in the NASDAQ. It's created one, it's created two, it hasn't created a third one yet. But when you look at the broader S&P index market, is creating all-time highs via the fact that these VIX curve is systematically retesting those lows. So as long as the VIX remains pinned in this 14.5, 15.5 range down here just above the yellow area, it obviously becomes a cause of positivity for these markets. But we know if there's any sort of elongated increases in volatility to the upside, like what we saw last Monday, last Tuesday, before that subsequent move back down, then of course that is your short-term narrative to be looking to at least be on the back foot or in that kind of counter trend situational play where these markets come back down again. As I said, we've seen it time and time again over the last a little under the last 4 weeks or so. We've seen plenty of corrective moves on the downside. So again, it's been attributed by short-term increases in volatility. Trading volume obviously factors into that. Seasonality factors into that. And of course, some of these data prints has factored into that as well, coupled with obviously market makers' general liquidity flow within these markets as well in the back end. All right, so fairly interesting narrative. Again, Wednesday, Thursday, ECB, PPI, CPI data prints coming out Wednesday and Thursday. A lot to potentially navigate this week. So obviously any sort of breakthrough 16.5 spikes higher, you're really looking again at a new short-term high in the VIX volatility curve. Now you have to remember this 20.5 level from the beginning of August has yet to be filled, this gap. So naturally, if there was any sort of negativity associated to PPI or CPI this week, that is probably where you'd look for it to go. And of course that means short-term high, corrective move, short-term high, corrective move, new high, corrective move. So again, in the broader range, not really doing a whole pile, but from a session to session, day to day perspective, a lot to potentially capitalize on as we move short-term perspective via longer-term perspective. All right, and then of course when you look at the other side of the equation, the DXY, we've talked about how constrained the DXY was over the last number of weeks, pretty much navigating through August or most of August, followed by that first week of September. Anytime we got to that 97.5 print, it systematically held it, it got recoveries, and then of course more recently into the back end of August we were seeing lower high, lower high, lower high. So really that 99 threshold level that we've talked about over the last 2 or 3 weeks was structurally so important, because unless the DXY was getting above that and really breaking out of this range, it was always that risk that these markets would just continue grinding. And of course situational play with the risk side of things, S&Ps, new all-time high, new all-time high, and new all-time high. And of course that becomes the risk that if this DXY play breaks through 97.5 and more presently breaks through that into Friday, navigating all of these key data prints, you're really then looking for, is there one final drive lower? And when you navigate out to the higher time frames, removing all of the noise, looking at the weekly perspective, we've had systematic breakdown, we've had many weeks of failed attempts on the DXY to get back above, to create any sort of nuance. Now we've talked about it quite evidently that don't be surprised to actually see the dollar rise in Q4 if we saw the Fed cutting rates. We saw it last year in 2024, we saw it in 2017, 2018, but evidently over the last number of weeks, as you look at the weekly structure, it certainly illustrates the fact that we could very easily have one more low before that does happen. And again, plays into short-term weaker narrative, formulate V-shaped bottoms, and then becomes corrective as we move into 2026. So we're looking at both narratives as we progress into November, December, as the Fed continues or re-implements cutting of rates, and of course in the back end as monetary supply kicks up. And of course if the monetary supply, which is something that drives very closely to dollar, if that really starts to pick up, well then that's your narrative to maybe pay more particular attention to the fact that global monetary supply, M2, is increasing rather than necessarily the continuation and Fed cuts, because of course that is something that we've obviously looked at quite heavily in the first 6 months of this year. All right, so let's see what happens there. Of course, we'll look at the global M2 over the next kind of month or so in the face of Fed cuts, as we move more broadly beyond that. But again, situational play, euro dollar at 117.5. Now it's gotten to its highest point since the 25th of July, where it came off that 117.70, 117.18 handle. But if you were to look at this, it's really starting to break out. It's gotten above this yellow consolidated region where it spent most of the last kind of 6 weeks or so. So that would be a fairly interesting narrative if this was to break out, maybe get a new high, 118s, systematically come back, retest, and then maybe try and kick on to those low 120s, maybe 121s, if we were to see that situational weaker dollar play, DXY that is, into, let's say, September, October, and maybe middle of November. So worth keeping a close eye on that one. Again, cable last week was very, very interesting. We talked about potential shorts, but on conditions. We had that V-shaped bottom out of the range of below 134s, followed by systematic retrace back into the yellow area. This yellow area was where we're kind of looking to see would there be any sort of selling print. We got a little near-term rejection into the weekend, of course, Friday, off the back of NFP, but failed to materialize as this yellow area held pretty clean. Then, of course, Monday, as this DXY play moved significantly lower over the last kind of 2-3 trading days in the face of Friday's NFP volatility, and moving obviously subsequently lower today through that 97.5, it has allowed that cable print to move back into that 135 range, basically meaning that this new lower low, or this breakdown followed by retrace, was effectively invalidated, and as such still remains invalidated. So for me, there's no point being short GBPUSD or euro dollar yet until we see over the next day or two how does this dollar react. Now, if we were to see a replication of last week where there's a wick down and bounce, and a wick down and a bounce by, let's say, Friday, it's a completely different argument. It's a completely different discussion, because it means then that these attempts for the DXY to break lower is initially attempting but failing to be sustained, and that for me is obviously very important as we move into, as I said, Wednesday and Thursday with PPI, CPI, and of course those data prints on Friday as well in the UK and the US. All right, so let's see what happens there. And I suppose the last 2 points is really looking at gold. Gold was on this runaway brick yesterday or last week. We had that breakout retest. We talked about last Monday and Tuesday. Then, of course, we saw that aggressive move on Tuesday into Wednesday. The apex back down. Subsequent new all-time highs was made on Tuesday. From there, we had that apex. So this was the holding pattern on Wednesday. Aggressive breakdown, followed by simultaneously retracing back to this value area. Now, this for me is really interesting because, of course, if people were long gold on a session base last Wednesday, most likely those who were long would have had their stop losses slightly below this yellow area. And of course, the wick down takes a lot of those stops out, and then of course creates a little bit of market trickery, but ultimately holds. So this is where using your confirmation closers, watching the value areas, I think is structurally very important. That markets can initially break above or below a level, but you want to be making sure those breaks are sustained. If not, your entries are going to be premature. You're going to get chopped out in volatility like this, and you want to be making sure those price structures are actually continually to break down through the course of the session, rather than creating an initial break but ultimately failing. And then since there, we've again had a subsequent break higher on Friday off of that weaker dollar, and this has continued again as gold has gone above 3,600. So really at this point, gold, new all-time highs, continues to aggressively break out. It's just been in complete and utter bull territory, and I think over the last 2 years, gold prices is up now over 90%. So if you've been holding gold in bullion, in coin form, or anything related to that over the last 2 years, or even silver as well, you have done very, very well in terms of the asset class appreciation. So very well done for any of them who've been involved in that. And of course, even now, from a trading perspective, you're even trying to find entries. There's a scramble to try and find entries here at 33, 3,400, when those moves systematically had continued to grind higher from the beginning of the year. So as I said, a lot of volatility. Gold has been very much been taken home over the last 6 months. And of course, if with M2 expected to continue in the back end of the year, it's only going to bring in the conversation of can gold hit 4,000 or 4,500 by year end. And at this point, with how aggressive it is, it's very hard to rule that out. All right. Now, last but not least, obviously in the crypto space, BTC we talked about last week. Obviously, this holding at 108, that's proven to be fairly prominent. On the week-to-week basis perspective, we've had 1, 2, and 3 touches at around about 112.5, 113. So that is posing as a short-term high, structurally speaking. So September, we know what traditionally is a very, very weak month for risk-denominated assets. Could we get one more breakdown to 108, 109s? Well, if you're looking at potentially buying BTC or buying Ethereum, you would probably want to see one more move lower to accrue value rather than trying to actually accumulate up here at 120, 112, 113 short-term highs. So let's see how that one develops over the next week or so. From a daily perspective, you can kind of see it yourself, those kind of springboard bounces, but ultimately failing on the last number of days above 113. So that becomes a fairly interesting narrative. And again, who's to say we can't have one more move lower into that 107, 108 handle over the next couple of weeks. And then, of course, as you look at Ethereum, it too formulated type of moves. Now, we've obviously closed the gap on futures. We've talked about over the last few weeks this kind of grind higher, but again, Ethereum structure proves to be kind of in the same boat, holding this 42, 43 range over the last week or two into that end of August, beginning of September. But who's to say we can't have one more trap low retest of this 38, 4,000 handle, which could very easily happen over the next few weeks. And for me, that is what I'm interested to see. Do we get one more breakdown into this area here, as I said, which I'm going to draw in yellow now, and that for me is going to be the interesting one. As I said, as we move into the middle of September, gauging out of the volatility this week, and of course into the seasonality factor, which we know, as I said, September can be quite bearish in the back end. All right, so that's pretty much it, folks. As we look at a cross asset basis, so as I said, 3 big things for me this week is PPI, CPI, Wednesday and Thursday, ECB on Thursday afternoon, see if there's any sort of inklings as we move into Q4. And then, of course, Friday we'll be back. I'll be back again tomorrow to gauge kind of volume into the open, but of course moving then into Friday as we move out of US data to see how does these markets reflect the volatility this week, which I think will be a fairly interesting call. And then, as I said, moving into weekly close in the backdrop of that on Friday the 12th. All right, so everyone, I will see you tomorrow. Have a good evening. Trade safe if you're holding positions overnight. Volatility on the rollovers has been quite intense the last few weeks. Just be mindful of that. And as I said, let's see what this week has to play out on. Thank you.